In this week's edition of The Property Imperative, we look back over 2017, the year in which the property market turned, focus on the risks to households increased, and banks are under the spotlight as never before. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Welcome to the penultimate edition of our weekly Property and Finance Digest for 2017. We start with the latest government budget statement, which came out this week. There was a modest improvement in the fiscal outlook, largely reflecting a boost in tax collections, including from higher corporate profits in the mining sector. But there was also a consumer-shaped hole, driven by lower wages, lower consumption and lower levels of consumer confidence. Yet, in the outlook, wages are predicted to rise back to 3%, and this supporting above-trend GDP growth. This all seems over-optimistic to me. And in any case, according to the IMF, GDP is a poor measure of economic progress, with its origins rooted firmly in production and manufacturing. In fact, GDP misrepresents productivity in the digital age, and they say companies that are making huge profits from mining big data have a responsibility to share their data with governments. The mortgage industry has seen growth in lending at around 6% through the year, initially led by investors piling into the market, but then following the belated regulatory intervention to slow higher risk interest only lending, momentum has switched to first-time buyers and refinancing at a time when some foreign buyers are less able to access the market. A third of customers with interest-only mortgages may not properly understand the type of loan they have taken out, which could put many in substantial stress when the time comes to pay their debt, UBS analysts have warned. We've also seen a change in mix as smaller lenders and non-banks, who are not under the same regulatory pressure, have increased their share. AFG's latest competition index, which came out yesterday, showed that Australia's major lenders have taken a hit, with their market share now down to a post-GFC low of 62.57% of the mortgage market. Household finances have been under pressure this year, with income growth 1/3 the rate of mortgage growth. So the various debt ratios are off the dial. As a nation, we have never been more indebted. This is a long-term issue created by a combination of government policy, RBA interest rate settings, the financialisation of property, and the rapid growth of property investors who hold 35% of mortgages, which is twice the proportion in the UK. The combination of rising cost of living and out-of-cycle rate rises have put pressure on many households as never before. And we have tracked the rise of mortgage stress through the year to an all-time high. The latest MLC Wealth Sentiment Survey contained further evidence of the pressure on households and their finances. Being able to save has been a challenge, MLC says, for a number of Australians. Almost 1 in 5 of us have been unable to save any of our income in recent years. And for more than 1 in 4 of us, only 1 to 5%. Expectations for future income growth are very conservative. Nearly 1 in 3 Australians expect no change in income over the next few years, and 15% expect it to fall. Our savings expectations for the future are also very conservative, with more than 1 in 5 Australians believing their savings will fall. The great Australian dream of home ownership is still a reality for many, but for some it is just a dream, with fewer than 1 in 10 Australians who said they didn't want to buy their own home, but 1 in 4 said home ownership was something they aspired to, but did not think it would happen. Of course, the RBA continues on one hand to warn of risks to households, as in the minutes published this week, yet also persists with its line that households can cope with the massive debt burden as it's skewed towards more wealthy groups. They keep referring to the Hilda survey, which is now 3 years old, as a basis for this assertion. But they should take note of a Bank of England working paper which looked at UK mortgage data in detail and concluded surveys tend to understate the true mortgage risks in the market, partly because of the methodology used. They concluded these results should make policymakers less sanguine about the developments in the UK mortgage market in recent years, which are traditionally analysed using these surveys. We think the same is true in Australia. The latest report from Standard & Poor's Global Ratings covered securitized mortgage pools in Australia to the end of October 2017 and showed 30-day delinquencies fell to 1.04% in October from 1.08% in September. They attribute part of the decline to a rise in outstanding loan balances during the month and many older loans in the portfolios, which may not be representative of all mortgages thanks to the selection criteria for securitized pools. But the 90-day default rate remains elevated and at a time when interest rates are at rock bottom. Banks are under the gun as the government has turned up the pressure this year. There are a number of inquiries in train from the wide-ranging Banking Royal Commission, which the government of course long resisted but then capitulated. And the Commission sent a notice requiring banks, insurance companies and superannuation funds to detail all cases of misconduct from 2008 onwards. The scope includes mortgage brokers and financial advisors. Also, the ACCC is looking into mortgage pricing. The Productivity Commission is looking at vertical integration. And we have the BEAR regime, which is looking at banking executive behaviour. This week, we also got sight of the enhanced financial services product decision obligations. And of course, the major banks copped the bank tax this year. There are also a number of cases before the courts. And this week, NAB said that it refunded $1.7 million for overcharging interest on home loans, and CommInsure paid $300,000 following ASIC concerns over misleading life insurance advertising. This tightening across the board is a reaction to earlier periods of market deregulation, privatisation and strong sector growth. But at its heart, the issue is a cultural one, where banks are primarily focusing on shareholder returns. As a company, of course, that is their job, but at the expense of their customers. Even now, the decks are stacked against customers, and the newly revised Banking Code of Conduct won't do much. We think that the Open Banking Initiative may eventually help to lift competition and force prices lower, but after many years of easy money, banks are having to work a lot harder and with much more lead in the saddlebags. Meantime, it's costing Australia Inc. dear. More significantly, the revised Basel rules, though watered down, still tilts the playing fields towards mortgage lending and makes productive lending to businesses less attractive. Also, there is more to do on bank stress testing, according to the Basel Committee. The regulation framework is, in our view, faulty. One question worth considering as the USA and other central banks lift their base cash rates is whether there is really a lower neutral rate now. Some, in a BIS working paper, have argued that central bankers' monetary policy has driven real interest rates lower rather than demographics. But another working paper, this time from the Bank of England, comes down on the other side of the argument. The paper, entitled Demographic Trends and Real Interest Rates, says 2/3 of the fall in rates are attributable to demographic changes, in which case central bankers are responding, not leading rates lower. In fact, pressure towards even lower rates will continue to increase, they say. This is a fundamentally important question to answer. We suspect the role of central bankers in driving rates is less significant than many suspect, and structural changes are indeed afoot. Rates in Australia have stayed low this year at 1.5%, despite the RBA saying this is below the neutral setting. And we expect the bank to move later in 2018 and upwards. The rate of rise is now expected to be lower than a year ago, but the international pressure will be up. In addition, the US tax reforms will likely switch more investment to the US, and so banks here who rely on international funding would likely have to pay more. So we still expect real rates to go higher ahead, creating more pressure on households. And of course, as rates rise, the cost of governments running deficits rises, something which will be a drag on the budget later. Home prices continue to rise through the first part of 2017, in the eastern states at least, while in the Northern Territories and Western Australia they fell, but recent corrections in Sydney may be an indication of what is ahead in the Melbourne market too. Demand remains strong, but lending standards have been tightened, and investors are getting more concerned about potential future capital appreciation. This year, building approvals were still pretty strong and in line with firm population growth. And as an aside, an OECD report this week said that Australian property may well be a target for money laundering, and that more needs to be done to address this issue. Auction volumes continue to slide, and we've seen a significant fall in recent weeks. So in this year, we have seen changes in the financial services landscape, the property market is on the turn, and households' debt levels are rising, creating financial stress for many. As a result, we expect many to spend less of this Christmas. Next time, we will discuss the likely trajectory through 2018. But to close, we wanted to wish all our followers a peaceful and restful holiday season. We've really appreciated all the interest in our work. Through the year, we have more than doubled our readership, thanks to you. I'm Martin North, Principal of Digital Finance Analytics. Many thanks for watching, and do check back next week to hear our views on what 2018 may bring.